Big news! The Federal Reserve just made a significant move by cutting interest rates by 0.5%. While that might not seem like much, this decision will impact the economy, the stock market, and even your wallet in major ways. Now, you might be wondering how I got this video out so quickly. The secret? I've been tracking the CME FedWatch Tool, which has been predicting this rate cut for weeks. In this video, I'll break down exactly what this rate cut means for savers, investors, the stock market, Bitcoin, and more. Plus, I'll dive into past data to show what we might expect. Stay tuned to the end, where I'll share how I'm personally handling my investments in light of these changes. Why did the Federal Reserve cut rates? To understand why the Federal Reserve made this decision, let's rewind a bit. For the past couple of years, the Fed has been steadily increasing interest rates to combat inflation, which peaked at a staggering 9.1% in June 2022, a level we hadn't seen in 40 years. This spike in inflation was largely driven by excessive money printing, similar to what happened in the late 1970s and early 1980s, when the Fed had to raise rates to as high as 20% to rein in inflation. Back then, this led to a recession, but it eventually helped stabilize the economy. Fast forward to today. While inflation hasn't reached the extremes of the 1980s, the Fed's rate hikes have been the most aggressive since that time. Now, inflation has cooled down to about 2.5%, which is why the Fed has decided it's safe to cut rates. They've lowered the federal funds rate, which is the interest rate banks charge each other to borrow money, and this directly impacts the interest rates we see as consumers. What does this mean for the stock market? Historically, when the Fed lowers interest rates, the stock market tends to respond positively. Data shows that in the past 100 years, 86% of the time, the S&P 500 has posted gains in the 12 months following a rate cut. However, it's not always a sure thing. If there's a recession, the stock market has been known to drop, with an average loss of 15% in the first year of a downturn. Currently, there's only an 8% chance of a recession in 2024, but the odds increase to 56% by 2026. Lower interest rates typically give stock prices a boost because companies can borrow money at a lower cost, increasing their profitability. But context matters. For example, during the dot-com bust and the financial crisis of 2007, the market still dropped after the Fed cut rates. Still, in many cases, stocks have surged following a rate cut. In 2019, for instance, stocks gained over 15% after the Fed lowered rates, and during the emergency rate cut in 2020, the stock market jumped by more than 60%. Typically, when interest rates are high, bonds do well, but when rates are cut, U.S. stocks and REITs, real estate investment trusts, usually outperform. Sectors that pay dividends, like utilities and real estate, often benefit the most in a low-rate environment since they usually carry significant debt. When borrowing costs drop, these companies become more profitable, which is great news if you're a dividend investor. How will bonds perform? Lower interest rates tend to drive up bond prices. As rates drop, bonds become more expensive, making them a stable, low-risk investment. While bonds aren't typically the go-to for many retail investors, they're a popular option for those looking to protect their wealth or for retirees who prioritize stable returns. What about Bitcoin? Now, let's talk about Bitcoin. With interest rates dropping, it'll be interesting to see how Bitcoin reacts. Looking at gold as an example, we've seen gold's value jump by 25% in 2024 alone. At the start of the year, gold's market cap was around $13.8 trillion, and it has since risen to $17.5 trillion. To put that into perspective, Bitcoin's market cap is about $1.1 trillion. Gold has added over $3.7 trillion to its market cap this year, more than 3 times the size of Bitcoin's entire market cap. If Bitcoin were to experience similar growth, its price could skyrocket to $174,000 from its current level of around $58,000. Historically, Bitcoin's price has been closely tied to market liquidity. When there's more money available, Bitcoin tends to do well. For instance, after the Fed slashed rates in 2020, Bitcoin surged from $7,000 to over $60,000 within a year, partially due to institutional investors like Tesla and MicroStrategy adding Bitcoin to their balance sheets. With more money in the system due to lower rates, Bitcoin could see similar gains. In fact, MicroStrategy is still buying more Bitcoin even at current prices, which is a positive signal for long-term holders. How will borrowers and savers be affected? For borrowers, this is great news. Lower rates mean cheaper loans, making it easier to finance big purchases like homes or cars, or to borrow for your business. On the flip side, if you've been enjoying high interest rates on your savings account, you might want to lock in those rates soon. Savings rates tend to drop quickly after a Fed rate cut. For example, in August 2024, the average interest rate on high-yield savings accounts was around 5.25%, but with this rate cut, banks have already started to lower savings rates. Historically, we've seen savings rates fall by about 0.25% to 0.5% within weeks of a Fed cut. During the last rate-cutting cycle in 2019, the national average for savings rates dropped from 2.2% to just under 1% in 3 months. If you're looking to lock in a higher rate, consider opening a long-term CD or focusing on accounts with longer maturity dates. Mortgage rates, which hit a 20-year high of 8% last year, should also start to decline. As of September 2024, the average 30-year fixed mortgage rate is 6.2%, but we could see it drop by 0.25% to 0.5% in the coming months.